we talk about volatility, and I like how you explained that in the 10-year, that it's a very tight window. It looks like it's really wild. In fact, even when I looked at it, I said, "Holy cow!" And then I realized it is such a minor or minute area that it moves around, but it projects like it's very volatile. And I think that makes good for a lot of people, because I remember the days when we were talking, and it's like people were waiting because they're waiting to find out things to kind of calm down and be a little more steady. Well, that's really what it's been for a long time, hasn't it?
It has. And see, one of the things you have to keep in mind whenever you're looking at any of these kind of charts, you've got to be very mindful of how those charts are created in terms of scale. Because I've seen charts where the movement from day to day or during the day can look really, really kind of exaggerated, even this chart that we showed today. But when you pay a little bit closer attention, then you realize when you look at it, it's like all these up and downs that look pretty extreme. Well, guess what? These are all within a range of about 4.42 and 4.5. That's not a big range. That's what the finance guys call a narrow trading range. But the chart is made to look like, man, you've got these massive movements. And of course, it reminds me, I hate to bring it up, but some of the charts that we were seeing during the pandemic, where you would see some of these moves and the number of cases reported and the number of deaths reported and so forth. And I would look at those from day to day and go, my gosh, we've had a major, major increase. But then when you look closer at the scale and, the horizontal and the vertical in terms of what the data points are that are being used to make that chart, then you suddenly realize, hey, the scale of this chart's been altered to make it look worse than it is. And so that's part of what's at play with these kind of things.